am Jason Yarusi of Yarusi Holdings. Welcome to this week's weekly webinar. So Yarusi Holdings, we are a multifamily investment firm here in Nashville, Tennessee, just south of it in Murfreesboro. We target underperforming properties, whether it's on the management side or the property side. And we'd like to dive in each and every week to bring you topics about how we can benefit from multifamily assets and the type of operations we use to find the best properties, perform with the best assets, and create the best returns for our investors. So today we're going to talk about the different types of course, funds we can use for multifamily investments. Typically, one of the most amazing things about real estate is that you can use leverage. So typically when you're buying stocks, when you're buying bonds, it's a dollar for dollar. So if you want to go buy stocks, you can buy $100 of stocks, but you'll most likely need $100 of your money to do so. Real estate offers the opportunity to pair different types of funds together to maximize the returns. So in most instances, we are using some form of debt, of bank financing, or some other types of financing to compare it with equity with the property. What this allows us for is that if we go forward to buy a property, we can typically find loans that will be cheaper for their payment than it would be for the cost of the returns that we will be seeking on our equity. So to be able to create better returns, we will use leverage along with our capital to buy these properties. So what could that look like? We may go buy a property that is an apartment building, 100-unit apartment building, and we may go seek bank financing. The bank may serve to give us a loan at 70% of the purchase price. So if it's a $10 million asset, we will get a $7 million loan, and then we will bring the remaining, the down payment, the fees, capital expenditures, any of the construction and closing costs in capital. So potentially we may bring $3.5 million, and then we'll get a $7 million bank loan. So the purchase price is $10 million. So of that 70% for the bank loan right there to $7 million, we may have an interest payment, and that interest may be 5.5, 6%. So we'll have a principal and interest payment of 6%. However, the equity, we may be seeking returns of 12%. So if we were to buy this property all in cash, it would water down the returns that we'd be able to seek, because we'd be seeking 12%, but because of the property, because it costs so much for the equity, it would be harder for us to find the return set that we're seeking for these properties for our investors. So the way we're able to do this is we're able to use leverage to our advantage. So instead of having 100% come from our money, we can maybe bring only 30, 35% and have the remainder come now from the debt that we're going to pair with it. Our goal here is that we can safely bring enough capital to make the best returns, but not utilize the bank financing in a way that puts the property at risk. So we typically rarely go up to 80% or any higher than 80% of the leverage. Typically we're into the low 70s, and the type of leverage we bring in these properties with the remaining come from cash. What this allows for us to do is this allows for us to lower our overall cost of capital. Because when you take and look at your cost of capital, it's going to be cheaper, like we said, for the debt than it is for the equity in most instances. So as we continue to pair this, we're going to continue to look for ways to structure the investment to be able to juice the returns. So a couple things. You can do, like we said, find some kind of debt, whether it be a bank financing, credit union, agency loan, a bridge lender, and then pair that with money that comes from our investors, our retail investors. Or you can also structure in layers to the capital stack. So you may have some option of bank financing, and then you may have another layer, and that could be pref equity or mezz debt. And the reason we may seek this is because it gives us another layer to lower our overall cost of capital, with the remainder coming of equity. So what could this look like? Maybe we could find a bank loan and the bank offers us 60% of leverage. And then we will go seek pref equity, which will look for a constant return of say 10%. And maybe we can get 15% of pref equity, leaving the remaining 25% and any of the other additional costs we need coming from equity. So if the equity we're seeking needs a return of 15%, ultimately over the course of the project, we're able to lower that. Instead of bringing 40% from the equity, we can bring 60% from debt, another 15% preferred return or preferred equity, and then the remaining 25% comes from equity. So you can look at this in a number of series of ways to make the investment the most beneficial for you and your team by finding the different levers that you can work symbiotically together to create the best investment out there for you and, of course, your investors. So as you think about the opportunities forward, think about the path. Think about the ways that you can maximize onto your investments. One of the other great ways here is that you can have some kind of construction loan. You can do the renovations, the repairs, create more value in the properties, and you can look for now permanent debt financing that can come in and recapitalize the property to create a better return for your investor, because you're going to be able to pull out their equity early, giving that money back in their pocket. So now every dollar of return they get going forward is almost going to be an infinite return, because the money from their initial investment has already been able to be returned to them. So as you continue to structure and look at the different ways you can size these deals and create a valuable deal for you and your investors, think about the opportunities ahead. Think about this part of how you can create more relationships to have different offerings, different series of bank lenders, different series of equity investors. So as you cut up the pie, as we say, you now are making an investment that continues to increase the overall return level of the property itself. All right. So I'm Jason Yarusi of Yarusi Holdings. Make sure, go down there, hit that follow button. Make sure you get alerted to when we have these weekly webinars coming up each and every Thursday for you here on LinkedIn. Happy to, of course, be in front of you. Happy to answer any of the conversations. Go over to yarusiholdings.com to learn more about us, our company, our offerings, our Multifamily Live podcast. Let's get out there. Let's make it happen. See you next week.